When it comes to investing, a popular management strategy known as the three-bucket portfolio gets a lot of attention. Even if you've never heard of it, you might already be applying some of its principles. That's true whether you're saving and investing during the career or you're working to make your money last in retirement. In this video, I'll walk you through its benefits, highlight some of the potential pitfalls, and share a modified version that could better suit your needs while making it easier to manage. The concept itself is grounded in sound reasoning, but in practice it can be challenging to implement and may lead to additional stress and costly mistakes during market volatility. The plan involves organizing your money into three distinct buckets. The first is your short-term bucket, often referred to as the cash bucket. During your working years, this might simply hold your emergency fund, while in retirement, it's intended to cover your living expenses for the next maybe 2 to 3 years. This bucket is filled with liquid investments, meaning they can be easily converted into cash. Examples include things like short duration CDs, U.S. Treasury bills, high yield savings accounts, or stable money market accounts. While the interest you earn on this money can help, its primary goal is to minimize any short-term risk. One major benefit of this bucket is that it helps manage your emotions during market volatility. In years when the market is down, you won't need to sell any investments at a loss to cover expenses. The second bucket is your intermediate bucket, often referred to as the fixed income bucket. This bucket is designed to cover expenses for maybe the next 3 to 10 years. The money in this middle bucket should continue to grow, at least to keep pace with inflation, but not include any high-risk assets. Common investments for this bucket might include longer maturity CDs, short-term bonds, dividend-paying funds, and funds focused on utility companies or REITs. In other words, this bucket consists of investments that are more suitable than the broad market overall by providing a steady income stream. Then we have bucket number 3, the growth bucket. This bucket is for your long-term investments and serves as the engine of your portfolio growth. It typically consists of stocks and other high-growth, high-volatility investments. These investments are designed to deliver returns that outpace inflation, allowing you to grow your nest egg over time and refill the cash and intermediate buckets as needed. Bucket 3 may experience more short-term volatility, but it offers more growth potential that you will need over a 10-year period or longer. Remember, even in retirement, it's important to maintain some long-term investments. A typical retirement can last 30 years or more, especially if you're retiring younger than the traditional retirement age. The three-bucket strategy has an initial appeal for several reasons. First, it can shield you from any short-term market fluctuations. Even if stocks take a significant drop, you're protected with 2 to 3 years worth of cash and an additional 5 to 8 years of relatively safer, more stable income-producing investments. Second, it isolates your stock investments into a bucket that you won't need to touch for many years. Third, the concept is easy to understand. However, there are some real drawbacks to this strategy. In theory, as you withdraw funds from bucket 1, you can refill it with assets from bucket 2, and then replenish bucket 2 with funds from bucket 3. The intent is to avoid selling investments during a down market to fund annual withdrawals. Bucket 1 is replenished through income, dividends, and investment performance from bucket 2. This strategy works well when all the buckets are performing well. When the market is doing well, you should consider selling some of your well-performing assets in the long-term bucket and take those profits and buy income-producing assets in the medium-term bucket. Then, To the extent possible, try to avoid selling assets in the long-term bucket during downturns. But what happens in a year like 2022, when the S&P 500 dropped 18% and bonds, often found in bucket 2, dropped 13%? As you draw from bucket 1, do you avoid refilling it after such a year because of losses in the other 2 buckets? Or do you leave bucket 1 with only 1 year of funds, knowing that bucket 2 also offers less of a buffer? This can introduce a layer of stress you didn't anticipate. What if only stocks decline, leaving bucket 3 with losses, and you pulled funds from bucket 1? The bucket strategy aims to insulate us from short-term market fluctuations, so we might resist transferring assets from bucket 3 and instead let bucket 1 and 2 gradually deplete while hoping for a stock market recovery. But this reduces our buffer and again may add to unwanted stress that may cause mistakes. This all leads to some critical questions. How much does the market need to fall before we stop touching bucket 3? Or how much does the market need to recover before we resume withdrawals from bucket 3? How long should bucket 1 and 2 be allowed to drain before refilling them from bucket 3, even if the market hasn't fully recovered? And then, do we ever consider drawing income from bucket 2 to add to bucket 3 during a down market to buy stocks when they're on sale? There's just so many questions, and they underscore the challenges of trying to apply this strategy in a real-world scenario. Let me take a quick moment here to say I'd really appreciate it if you hit the like button, maybe leave some comments below. It helps the algorithm and supports the channel, so thank you. Another little problem with this strategy is it doesn't really address rebalancing within the bucket. As a result, when the markets are down, the bucket strategy usually either keeps moving money from bucket 3 or leaves it alone until some uncertain point in the future when the markets recover. But consider the common 60-40 stock-bond split portfolio. In this case, during a bad stock market, where bonds hold up maybe better, you'd be selling some bonds and buying stocks after they have dropped to rebalance to get back to the 60-40. Essentially, buying some stocks when they're on sale. So managing and adjusting this strategy according to market fluctuations can require time and effort, which some people may not really like and find challenging. But regardless of your strategy, you need to answer some basic questions. First, figure out how much you need in that safety bucket. To do this, start with your yearly living expenses, include loan payments and personal desires, like maybe traveling. Second, consider what income you may have to supplement these expenses, such things like pension, Social Security, dividends from investments, or interest income. Third, estimate the gap between your expenses and your income, factoring in any taxes you might owe. Now you have a better understanding of what's needed in your first bucket. If you want 3 years of security, multiply that gap by 3. So let's say your yearly gap is $40,000. And after filling bucket 1, you got $1.5 million available for the other 2 buckets. In that case, there's really no reason to worry about having 2 more buckets. Using the standard 4% rule, $1.5 million could provide $60,000 per year in the first year and then adjusted for inflation for 30 years with essentially no risk of running out of money. And in many cases, it'll provide even more. Heck, just for an example, let's say that $1.5 million was invested like this: $800,000 in the S&P 500, $600,000 in a dividend fund similar to SCHD, and $100,000 in a high-yield savings account paying 4%. Just the dividends and interest would bring you in around $36,000 without selling anything, and the stocks would grow over the long term to take care of inflation. To really understand everything you need to know about the 4% rule, check out this video right here. I'll leave a link in the description below. So, in a situation like this, with a $40,000 gap and the ability to safely withdraw $60,000 a year, do you even need bucket one? Maybe not. You could just stick to one basic portfolio with the right asset allocation. The 4% rule gives you what you need and then some. There's really no need to stress about all these different buckets. The beauty of this approach is not just its effectiveness, but its simplicity. If you have different types of accounts, like a personal brokerage account, Roth type of retirement accounts, and traditional type of retirement accounts, it could really matter for tax purposes how you withdraw that. For example, it's usually smart to move interest and dividends from a taxable account into your spending account, especially if they're already being taxed. Once you hit the age of 73, you might also want to move your required minimum distributions, your RMDs, into the cash account, since they're being taxed anyway. Whenever possible, it's a good idea to let your Roth accounts grow as long as you can and focus on using your taxable accounts first. This way, you're maximizing tax efficiency while keeping your strategy simple and effective. During your working years, it's ideal to save at least 6 months' worth of expenses in your emergency fund. This should be easily accessible, so keeping it in something like a high-yield savings account or stable money market account is a good idea. When you're nearing or in retirement, the biggest risk to your financial security is what's known as the sequence of returns risk. To really understand everything you should know about that, I'd recommend watching this video here. I'll leave a link to it below too. Personally, I don't think much about the whole bucket 1, 2, 3 approach. To me, it just feels like a more complicated way of looking at asset allocation. If it helps you do mental accounting, that's great. But basically, it seems like it's easier to understand for most investors, but may end up being more difficult to actually put into implementation. Whatever your income gap is, between pensions, Social Security dividends or interest, and your total yearly expenses, it's helpful if your portfolio can cover that gap with stable investments for at least 5 to 7 years. For the rest, I usually prefer to keep it in a diversified stock portfolio. That said, my risk tolerance might be higher than what others are comfortable with. So it really depends on your personal situation and comfort level with volatility. I view it as just one overall portfolio with a mix of assets rather than breaking it down into a bunch of buckets. The bucket approach is really just another way of thinking about the proper asset allocation. The important thing to remember is that both approaches recommend regular rebalancing of your assets. For example, if your portfolio is set up as 60% stocks, 30% stable assets, and 10% cash, and the stocks have had a fantastic year like in 2023 and 2024, when the S&P 500 was up 26% and 25%, your stock allocation might grow to 70% in that case. So you would sell some of your stocks and rebalance back to your desired 60-30-10 allocation. On the other hand, if stocks drop and your stock allocation falls to 50%, you could sell some of your stable investments to buy stocks while they're down, rebalancing back to the original target. In theory, this helps you sell high and buy low during market fluctuations. Studies have shown that rebalancing can increase the likelihood of a portfolio lasting longer over time. So ultimately, it may just be easier to maintain an emergency fund in stable assets to provide near-term security you seek, and then manage an overall portfolio with the proper asset mix. I encourage you to check out the video on the 4% rule and various safe withdrawal rates to gain a better understanding of this simple rule. If you prefer the 3-bucket strategy, I hope at least you now have a better understanding of some of its nuances and the things that make it challenging. So thank you for watching. Please hit the like button.